What's up, everybody? Genix Dividend Investor here. In this episode, I'm going to try to settle a debate of what's the best dividend portfolio. I'll then end things by sharing some blunt financial truths that became painfully real as I helped my mother-in-law move this weekend. And to kick things off, I ask you this question. Is the best dividend portfolio the one that generates you the most passive income over time? Is it the one that grows the largest? Maybe it's the one that protects you the most if we have a big stock crash. The truth is, there's no single universal answer, and it really depends on your goals, timelines, and risk tolerances. So let's take a look at 5 different types of portfolios to see which ones resonate the most with you. Let me introduce you to Conservative Clarence, Balanced Bobby, Growth Gary, High Yield Harry, and Risky Rick. You might be surprised at how their simulated portfolios perform in different kinds of markets, and I bet you'll be curious to see who actually comes out on top. Of course, winning can be subjective when it comes to portfolios. The truth is, what counts as winning for you might look very different from what it means to me. I mean, how much we each care about current yield, dividend growth, stock appreciation, tax efficiency, resilience in downturns, or whatever really shapes the kind of portfolio we build. So let's bring these concepts to life through those relatable investors. First up is Conservative Clarence, who puts safety first, and he's in retirement so he wants more income than the market average. Clarence isn't just conservative, he's a worrier. He's probably a grandfather who's seen a few market crashes, and he's not about to let his nest egg become a statistic. For Clarence, winning isn't the biggest number on a screen, it's a good night's rest. When you look at his portfolio metrics, it's boring, and that's exactly how he likes it. He'd rather have a steady, predictable dividend check than a wild ride. So for him, it's about how much he keeps, not about how much more he makes. He sticks with stable blue-chip companies and reliable dividend payers. He's not chasing big returns, but he wants steady income and peace of mind. So for him, I assumed a 3.5% dividend yield and a 6% stock appreciation, along with a 6% dividend CAGR. I'll also assume that his conservative portfolio means his dividends don't get cut, and that he has a crash sensitivity of 70%. Crash sensitivity is basically how much harder or softer a portfolio gets hit when the market goes down. It's kind of like beta. So like if the market return in a year is minus 10% and someone has a crash sensitivity of 1, then they lose 10%. If they have a crash sensitivity of 0.7, then they'd lose 7%, i.e. they're more defensive. If they have a sensitivity of 1.5, then they'd lose 15%, which means they're more volatile than the market. So bottom line, Clarence loses less in a down market. Next up is Balanced Bobby, who takes a middle-of-the-road approach. Bobby is disciplined and he's rational. He's not interested in get-rich-quick schemes, but he's also not willing to sit on the sidelines. His portfolio is a mirror of his personality, i.e. a blend of stability and ambition. He knows he probably won't be the star of the show, but he'll probably never be a cautionary tale either. Bobby's goal is to keep up with the market, capture a little bit of everything, and have a smooth ride. For him, balance is the ultimate strength. He wants a mix of yield and growth. His goal is to balance risk and reward without going too far in either direction. I'll assume he has a 2.5% yield and a 7% appreciation, along with a 7% dividend CAGR. And given his quality portfolio, I'll assume his dividends don't get cut, and I put his crash sensitivity at 100%. Next is Growth Gary, who's aiming for long-term appreciation and dividend growth. Gary's a dreamer. He's probably in his 20s or 30s, looking decades down the road. He sees a smaller dividend yield not as an income stream, but as a seed. He's planting those seeds, knowing that with time, appreciation, and consistent dividend growth, that tiny dividend should grow into a giant, beautiful snowball. He's got patience for the long game, because his version of winning is building a massive portfolio that can one day provide generational wealth. What excites him is dividend growth and stock appreciation that can compound over decades. I assumed his dividends grow consistently from a small base, and I assumed that he has a 1.5% yield and 10% appreciation, along with a 9% dividend CAGR, and is at 100% sensitivity. Compare him to High Yield Harry, who's focused on income right now. For Harry, a portfolio isn't just an abstract number, it's his livelihood. He's hopefully in retirement, and his portfolio is his paycheck. He sees his high-yield stocks like a reliable job. Every dividend payment is a concrete, tangible event that pays for groceries, a trip, or a new set of golf clubs. His big question isn't about tomorrow's stock price, it's about whether that paycheck will show up in his account each month or quarter. I'll assume he has a 6% yield and a 0% appreciation, along with a 0% dividend CAGR. I also assumed a crash sensitivity of 100% and some dividend cuts along the way. And then there's Risky Rick. Rick likes to swing for the fences, and he's totally fine with big ups and big downs. He believes that fortune favors the bold. He's the guy who buys aggressive, high-beta stocks, and he's glued to his screen during the trading day, thriving on the volatility. When the market's booming, he feels like a genius. But when things crash, then he gets nailed more than the market. Bottom line, he's willing to take on huge volatility and concentrated bets if it means there's a decent chance at outsized returns. I'll assume he has a 4% yield and a 12% appreciation in bull markets, volatile or down in others, along with a 3% dividend CAGR. I gave him a crash sensitivity of 150%, which means he loses more on average in down markets, and I assume some dividend cuts in crashes. I modeled these different investors on ChatGPT, Gemini, and Grok, and took an average of their simulated results. I assumed everyone started at 100K portfolios and that all dividends were reinvested. Of course, that's not realistic for Clarence and maybe Harry, who would probably be spending a good chunk of that income. But reinvestment lets us compare apples to apples across the different investor types. So think of these numbers as showing portfolio potential rather than lived reality. And I did this for 4 different market types, including number 1, a 10-year bull market, number 2, a 10-year sideways market, number 3, a 10-year declining market, and number 4, a bull market for 5 years followed by a crash and back into a bull market again. Obviously, there are a lot of variables that can influence stuff like this, including taxes and account types and specific tickers, but it gives you a flavor for things. And in case the crash sensitivity aspect doesn't make sense to you, then just think of it like this. Crash sensitivity is a portfolio's seatbelt. Clarence has a snug one, Rick basically doesn't wear one, and everyone else is somewhere in between following the market. And in some cases, their specific portfolios could adjust things up or down. Like conservative Clarence holds defensive blue chips and stable dividend payers, so he tends not to fall hard in crashes. Balanced Bobby tracks the market more or less evenly. Growth Gary often swings harder. Those dividend growth stocks often fall about the same as the broad market. High Yield Harry can have some more risk in payout terms, but in price terms he often falls in line with the market. And Risky Rick is holding more aggressive growth and high beta holdings, which often swing worse than the market, so when the market drops 20%, Rick could be down 30% or whatever. Okay, now let's look at the results the AI's averaged out, and I rounded things a bit. First up is the 10-year bull market. Risky Rick came out with the largest portfolio value, ending at 448K along with total dividends paid at 37K. Next is Growth Gary with a final portfolio value of 356K with total dividends paid of 26K. Conservative Clarence was next with a final value of 253K along with total dividends of 55K. Then we have Balanced Bobby at a final value of 252K along with total dividends of 39K. And finally High Yield Harry at a final value of 177K with total dividends paid of 77K. So in that 10-year bull market, we see that appreciation really drives things. Rick and Gary did well because their portfolios are built for growth and compounding. Clarence and Bobby do okay, but they just can't keep up with the higher flyers. And Harry looks good on income, but his lack of growth keeps him from making big gains when prices are climbing. Next up is a 10-year sideways market, which most people hate to see. In this one we find that High Yield Harry ends with the highest portfolio value at 177K, and his total dividends paid are at 77K. Conservative Clarence is next with a final value of 157K, along with total dividends of 57K. Balanced Bobby is next with a final value of 140K and total dividends of 40K. Then is Growth Gary at a final value of 127K and total dividends of 27K. And finally we have Risky Rick at a final value of 108K with total dividends of 8K. So in a sideways market, steady income makes all the difference. Clarence and Harry look like champs because their dividends keep paying, even when prices don't really move too much. Bobby holds his own, but Gary stalls out since his growth engine never kicks in. Rick's big swings just cancel each other out, leaving him with no real progress after 10 years. So one thing to realize is that risk isn't just about losing or gaining money, it's also about a portfolio's volatility. I mean, some portfolios can have a lot of volatility, like Risky Rick's, without necessarily leading to a higher long-term return. In a sideways market, all the wild swinging amounts to potentially nothing. This reinforces the idea that an active, risky strategy can feel like a lot of work for a low payoff in certain market conditions. Moving on, we come to a dreaded 10-year declining market. In this one, we see that conservative Clarence ends at a final value of 133K, along with total dividends of 58K. Next is High Yield Harry at a final value of 133K, but with total dividends of 69K. After him is Balanced Bobby at a final value of 110K, along with total dividends of 41K. Then we have Growth Gary at a final value of 94K, along with total dividends of 26K. And finally Risky Rick at a final value of 88K, along with total dividends of 34K. So in a declining market, defensive trades really show their value. Clarence holds up the best, with stable blue chips softening the blow and dividends still coming in. Harry looks more resilient than you'd expect because his payouts cushion the drop, but that only works if the dividends don't disappear. Bobby and Gary do okay, but probably don't have enough income to offset the market. And finally Rick doesn't look good, showing how risky it can be to swing for the fences when markets go south. Then the last market I simulate is a mixed one, where we have 5 years of up, then a crash, then a few more years of up again. This time we see that Risky Rick ends up top with a final value of $215K and total dividends paid of $35K. Next is Growth Gary with a final value of $220K and total dividends paid of $26K. Then is Conservative Clarence at a final portfolio of $197K along with total dividends of $56K. Then we have Balanced Bobby at a final portfolio of $173K along with total dividends of $40K. And finally, High Yield Harry ends at $133K but with total dividends paid of $74K. In a mixed cycle, early gains get wiped out by the crash. Rick and Gary surge in the first 5 years, but one big drop erases a lot of that progress. Clarence is steady and recovers smoothly, and Bobby ends up in the middle, true to his balanced style. Harry's income cushions the ride, but without growth he still trails by the end. So to summarize things, in a bull market, Rick and Gary lead on total return. Harry shines on income but lags in growth, and Clarence and Bobby stay steady in the middle. In a sideways market, Harry and Clarence look best since dividends keep them afloat. Gary looks weak with no price lift and a small starting yield, and Rick's volatility hurts him. In a declining market, Clarence preserves capital the best. Harry's cuts hurt, but he still gets more income than most. Bobby and Gary shrink and Rick gets hit the hardest. And in a mixed cycle, Clarence is steady. Bobby sits in the middle, Gary takes longer to recover, Harry pays lots of income but lags without growth, and Rick soars early but gets crushed in the crash. So all of that kind of helps demonstrate the classic finance principle that higher potential returns come with higher risk. Rick's high appreciation rate leads to the best returns in a bull market, but also the worst returns in a declining one. The simulations also show how compounding on both dividends and capital appreciation works differently. Like in a bull market, the compounding of high appreciation rates often drives returns. In a sideways market, compounding through reinvested dividends is the only engine for growth. This also highlights the fundamental difference between an income-focused strategy like Harry's and a growth-focused one like Gary's. I mean, Harry's high initial yield provides immediate value, but his lack of appreciation leaves him behind in bull markets. Gary's low initial yield pays off immensely in a growth environment, but leaves him vulnerable in a flat or declining market. And by including that crash sensitivity metric, I've tried to better model the real-world behavior of different asset types. Like Clarence's defensive posture and low sensitivity can help protect him in a crash, at least to some degree, while Rick's aggressive stance, high sensitivity, amplifies his losses, accurately reflecting how high beta stocks often behave. And then the mixed cycle scenario is helpful because it shows that investment returns aren't just about the final outcome, but also the journey. Like the crash in the middle disproportionately hurts the most aggressive portfolios, demonstrating that a single negative event can wipe out years of superior performance, which ties to a concept known as path dependency. Thus, the order of returns can matter more than the average return. I mean, a portfolio that starts with losses or suffers a major crash early may never be able to catch up, no matter how strong the subsequent market is, because its compounding base has been permanently reset. It's kind of like a high-growth portfolio is a runner who sprints ahead for miles, but then trips and falls, breaking their leg. Even after they heal and start running again, they're probably not just slower, they might remain permanently behind the runner who just maintained a steady pace. But again, there's a lot of nuance in this, so the more interesting question is which of these portfolios best align to your needs given where you are right now? Are you more of a conservative Clarence or a risky Rick? Maybe you're part high yield Harry and growth Gary, or maybe you're balanced Bobby. Leave me a comment and tell me what you think. A takeaway is that there really isn't a winner per se, it's more about what aligns to your needs, goals, timelines, and risk tolerances. I mean, it's kind of like asking what's better, apple or cherry pie, blondes or brunettes, Twizzlers or red vines. Actually no, that's stupid because everyone knows red vines are best. Seriously though, cherry pie might be the best for someone who wants a quick, sweet treat today, like high yield Harry. Or perhaps apple pie, with its hearty, enduring flavor, is a better choice for the long-term eater, like growth Gary. It's all about what you're hungry for over time. The real winner in all this is the person who has a good understanding of trade-offs and pros and cons of how they choose to invest, and then successfully builds a portfolio that aligns to their interests. That's why there isn't a single right way to invest. And note, there are tons of other archetypes that I could have included, like Aristocrat Alice, Monthly Molly, Index Ivan, and REIT Ralph, to name a few. It all depends on you. Are you in retirement, wanting a more consistent income stream? Maybe you're a young investor looking for strong growth and the ability to eventually have a giant dividend snowball growing in their Roth. Each person watching has their own realities which will shape what they do. And who am I to say that what you're doing doesn't make sense for you? But with that being said, now let me tell you about someone who is doing something that doesn't make sense for them, i.e. I want to share some blunt financial truths that became painfully real to me as I was helping my mother-in-law move into a new place this weekend. She's a nice lady, but over the course of her life she's made some bad decisions, and they're really hurting her right now. She started smoking and drinking in high school, and she's still doing it 60 years later. She's in her 70s, still spending a big chunk of her only income, which is Social Security, on booze and cigarettes. Her health's very poor, exactly what you'd expect from that lifestyle. She worked as an office manager, but she never invested a penny for retirement. Today her assets are basically a rundown car and a storage unit. And what's in that storage unit? Well, garbage bags full of empty hangers, broken furniture, gas lawnmowers that don't run, and piles of random knickknacks that she's collected over the decades. She gets around $1,500 a month from Social Security, yet spends $300 of it just to keep paying for that storage unit. I told her it might make sense to pull out the few things she truly values and let go of the rest, then use the extra cash she'd have from no longer paying the storage fees. I mean, she hadn't even opened her storage for like 7 years until we came to help her move. So think of that. $300 a month, 12 months a year, times 7 years is $25,000 of pure cash. That easily could be a $35,000 portfolio right now, throwing off a save $150 a month in income. Anyway, my wife and I spent about 25 hours over 2 days packing, renting U-Hauls, and hauling her stuff between places and the dump. But that storage unit is something she likes having, so I don't know what to say. I told her I'd be willing to help her invest and I'd give her matching cash to help her grow her portfolio in retirement. Like if she invested $100 into a new portfolio, then I'd toss in another $100 to incentivize her to grow it. I explained how her dividend cash flow could grow and how even minimal investments could yield a 5-figure portfolio relatively soon, and after a few years she could easily be making another $50 a month that would probably outpace inflation. But she didn't want to change, and that's when it kinda hit me. For her, the real issue isn't about opportunity, it's more about a lack of discipline. The discipline to step away from habits that drain her. The discipline to save when it's easier to spend. The discipline to let go of things that don't matter so she can build something that does. That lack of discipline is what's kept her stuck for decades, and it's the same thing that's keeping her from making a change even today. My guess is that if she had more discipline, then she could have beaten her addictions decades ago. She probably would have saved for retirement. That same lack of discipline seemingly makes her hold on to junk in a storage unit instead of letting go and building something for the future. And that's probably why she said no thanks to me. So building wealth isn't just about numbers, it's about discipline. The discipline to resist instant comfort. The discipline to delay gratification. The discipline to plan ahead and follow through. So that's the discipline that my mother-in-law is seemingly lacking. It's a similar discipline that every one of us needs if our goal is to grow a large dividend portfolio. The discipline to keep investing. The discipline to live within a budget. The discipline to stay the course. That all being said, I'm probably part of the problem with my mother-in-law. I mean, I've paid for her storage unit's monthly charge multiple times, along with some of her other bills. At the time it felt like the right thing to do, but looking back, maybe I was just making it easier for her to avoid making the tough change. And that's the hard part. Discipline isn't only about how we handle our own money. Sometimes it's also about when to stop bailing someone out, even when we love them, because stepping in too much can actually keep them stuck. It made me realize that I've got to practice more discipline as well. Not just with investing, not just with saving, but with the way I support the people around me. Because real discipline isn't only financial, it's also emotional. So tell me what you guys think I should do. Like, do I keep helping a little when she needs it? Do I step in even more? Or do I have to accept that nothing's changing and step back? Leave me a comment with your thoughts, and please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to close things off with a shout out to my newest channel member, Judah Redway. Channel members get a variety of perks, including a badge icon that shows by their comments on my videos that can level up over time. They also get to vote on which thumbnails I use for my videos, and they get to watch my videos usually the day before I share them publicly on Saturday mornings. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Riv8185, Yippee77777, Winston7751, Brian Duvall5846, L. Cunningham, or maybe it's Cunningham, then multiple from Billy Johnson 9166, multiple from Gayer Kedge, multiple from Noxious News, and multiple from IO Nut Loan CA 6339. I also want to shout out John7264, who also left a nice comment, as well as something interesting I think you'd like to hear. He said he's been a dividend investor for 35 years now and recently retired and is living on dividends. His entire working career was in electronic manufacturing, where he had to deal with layoffs that happened every 2 years, along with temporary pay cuts and stuff like that. He said his portfolio of 45 dividend tickers has been more stable and reliable than any of his W-2 paying jobs ever were. And I gotta say I relate, because I feel the same way about my dividend income. I mean, I trust its income far more than any jobs I ever had. Now, don't get me wrong, I know that I can and most likely will get some dividend cuts or suspensions in the future, but that would probably just be a hiccup to my income coming in. It wouldn't be like losing all of my job income at once. And with that, I'll close things off and recommend you check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'll also pitch my FastGraphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page and/or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.